So I'm going to talk briefly about something which is very different. It's the first step of the Gavekal group into a new field, which is artificial intelligence. The software that we're launching today is the result of a 3-year research program. And it's a software that, as Charles was saying, is tracking equity risk in 40 countries throughout the world. On a monthly basis and in a binary manner, so risk on, risk off. So among the 3 main topics that any investor has to, look at, which is value, perspective, and risk, this system knows very little about value, has no idea whatsoever about perspective, but it's looking at risk only. So we joined the Gavekal group in 2014. At the time, we were a small asset management team of 5 people, 3 people from the research side, headed by Yann Ajon, who is a former research engineer from the CNRS in France, which is the National Center for Scientific Research, and 2 persons from the asset management side, Michael Didier, who is over there, and me. And Michael and I had a sort of similar career. We both started, managing prop desk and arbitrage desk in investment banks. Then we both set up hedge funds, and then we teamed up later to manage global portfolio for institutional investors. And in 2014, Louis and Charles tell us, why don't you join the group to develop software that could be useful to our client base? The first, and it becomes a new company, Gavekal Intelligence Software, and now Charles is the chairman of this company and is back to France to support the development of this company. So the research program had 3 phases. The first phase lasted 12 months. And in fact, what's the first mission that Charles gives us is to revisit all the investment rules that he had been developing for the last 10, 20, 30 years, and to tell him whether they make sense, they all make sense, of course, but whether they are statistically significant or not. And it has taken 12 months because it was very difficult to conclude. So we made a very important decision, which was to only look at the rules that would be somewhat general or universal, which means that would be applied to any country in the world. And by doing that, of course, we've reduced the scope of the research, but we have massively expanded the data sample, and then we could conclude. It was a massive destruction process. We destroyed something like 90% of the rules, and only 7 rules survived the process. So I'm going to show you briefly what these rules are about. So you have the famous first 4 quadrants by Charles Gave. I think this is something he started talking about in the 70s. It's basically saying that if you are in a country where inflation is going down and growth is picking up, then it's very equity friendly. You can just invest and close your eyes. And if you are in the other quadrants, the reverse one, which is inflation going up, growth going down, this is very dangerous for equities. The 2 other quadrants are more debatable, but that's the first rule. It's a local rule. The second rule is the only monetary rule. It's the world liquidity in US dollar. This is a diffusing rule in the sense that it's applied to every country in the world. It's not local. In fact, we have 3 diffusing rules and we have 4 local rules. The 2 other diffusing rules are the world trade, that is affecting all countries in the world, and the commodity prices. Of course, commodity prices is slightly different because it's a zero-sum game. So what is good for one country is bad for another country. So it depends on the trading position or on whether the countries are commodity exporters or not. So these are the 3 diffusing rules throughout the world. The other local rules are valuation of the assets, of the equities. This is probably the weakest rule that we have. It's very difficult to, we managed to find signals to buy equity when they are cheap, but we never managed to find signals to sell equities when they are expensive. We have another rule, which is foreign exchange, of course, competitiveness of a country vis-à-vis its trading partners. And the last one is the wealth effect, which is the momentum rule, if you wish. We wanted just to be able to grab a rule that, would activate negatively if there was some kind of speculation in the market. When people sell because other people sell, that's dangerous. So we've just wanted to add the 3 main asset classes in each country, which are real estate, bonds, and commodities, and see if they were, going up or down on a 1-year basis. We could not find all the data for real estate, so we had to restrict the rule to equities and bonds. So what you see here on the screen is that all these rules, you have time going from left to right. right, and you see that these rules are flipping. They are relatively unstable. And it's the addition of artificial intelligence that will stabilize the signal. The first line is the conclusion of the signal, and you see it's a lot more stable. If it's blue, it means it's okay in terms of risk return, and if it's red, it means there's a risk, or at least statistically, the situation has not been good. So the second phase lasted 6 months, and that was the introduction of the artificial intelligence technology. We had been working on that for 13, 14 years, so of course we have a lot of technology behind that, but that is not the most important thing. The most important thing is the way we program the neural network. What we try and do is at each and every step of the programmation, we try to imitate the way humans think. And I will just give you 2 examples of that. The first one is the discretization of the signals. We think in terms of risk states, in terms of probability. We do not think in terms of continuous signal. It means that for us, if, for instance, oil is going up by 25% or 50%, it's the same thing. We are sure that oil is going up, and as such, it's pretty good for Russian equities. We think this is exactly what is happening in our brain. For instance, when you have a neuron in your brain which is stimulated, the neuron gets charged and nothing happens until the charge reaches a certain threshold. And if it reaches this threshold, then the neuron fires and the information is transmitted. So it's a discretization of the signal. The second example is the notion of very nonlinear response. We think that humans have very nonlinear response to stimulations. This is the example on the right side here. You have a situation where, for instance, you have 4 rules which are gray, which means we don't know, we cannot conclude, so it's worth 0. We have 2 rules which are pink, which means they are slightly bad, and 1 which is deep blue. It means we are absolutely sure that the good thing is happening in the equity markets, given that rule. If we had a linear programmation, the answer would be negative, because we have 2 negative, 1 positive, and 4 neutral. In fact, our answer would be exactly the opposite. It would be positive. Why? Because we think that if you have a good news, let's say you wake up in the morning and you have a very good news, this good news will be overwhelming. It will take the lead over all the rest. And in fact, a human way of thinking is similar to that. We have different kinds of interests in our life. We have the professional life, we have social life, we have family life, etc., sports, culture, whatever. But the fact is that we don't equate that. We dynamically overweight what are the very good news and the very bad news. The consequence is that in the system, a very good news can only be compensated by very bad news or by a long series of disappointment. After 18 months, we have something which is working quite well. So Charles says, okay, but then are you sure of it? And of course, we can't be sure, because there's always a huge risk of overfitting when you do models. But we've done a number of things to try to mitigate this risk. We know there should be left some overfitting. But what we've done is a series of things. The first thing is that we started from chance rules. We did not start from the data. So we have not tried to calculate millions of correlation that would explain the past but would never would be meaningless for the future. That's very important. The second thing is that we apply all the same rules and the same combination to every market, so that reduces the risk of overfitting. The third thing is that when we optimize the system, we only optimized it, which is just the weighting of all the rules. We optimize it on 3 markets only, which are the US, Germany, and Japan. And then we expanded it to 37 countries. So, last year, China had a 50% drawdown, for instance, and it was not optimized for China. And it worked pretty well. So, and the last thing is that we did a lot of resiliency tests, which means that we developed a program to take out randomly 1 rule, then 2, then 3, and we saw how the system was reacting. And up to 3 rules extracted from the system is still stable. It still provides signals which are which are worth looking at in terms of risk return as compared to a long-only position. The conclusion is that there is not a single rule which is dominant. You can take out 1, 2, or 3, the system will still be live. Despite that, Charles told us, let's wait and see. So he said, please keep it live for 1 year, and then we'll see after that. And in fact, we kept it for 18 months. So let's quickly see what has happened in the last 18 months. So when you get into the software, you first arrive to a heat map, which is basically looking at 40 markets and telling you whether they are blue or red. Blue means okay, red is not okay. This is the heat map of the end of February, so for the month of March. It's applied to the whole month of March. What you see is that basically the system is saying there is no risk in equity whatsoever. And the system has been saying that. This is the heat map with, again, time going from left to right and the countries listed, here developed and here emerging. And you see that the system has been saying the same thing for 7 months in a row. He has not seen any risk whatsoever. But if we look back now, 18 months ago, and especially emerging market, we see that the situation was quite similar as it is today. But something then happened. We saw Russia turning red. That was the first country to turn red. And then in developed economies, the second, which at the bottom, was Norway, which turned red a few months later. Then back to emerging countries, at the bottom, we saw that Mexico and Chile turned red. So in fact, the system was just seeing that we had a deflationary shock on oil prices, which was bad for commodity exporters. But that should have, that could have been only limited to this part of the world. But what has happened as well, let me go back, and you see the second rule, which is the world US dollar base. The world US dollar base, so the liquidity in dollar, turned red. That was more or less coincidental. And this, by the way, is still saying it's red since then. So the system is constantly saying that there's a shortage of dollar in the world. But this affected, in fact, emerging economies, especially Asia. So a few months later, Asia turned red. And then again, developed economies were still okay. But look at let me go back to this period of time. Look at the world trade. You see the second from the bottom. The world trade then, again, 5-6 months later, started to turn gray and red. So we had a propagation effect from commodity exporters to Asia and then to developed economies. And at the end, there was a massive reduction of risk that was suggested by the system. If we look at a global portfolio, the system lets you, take whatever type of portfolio and simulate your own. But if I take the 40 countries weighted by their GDP, for example, and we see what the system has done in the last 18 months, we see that 18 months ago, the system was saying be massively invested in equities. And suddenly it started to say reduce the risk down to 0, and then get back in by mid-2016, 50% invested, and up to 100% in the last 7 months. Of course, by doing that, the system has been very performant. That's the backtest plus the last period. But what's most important is in terms of drawdown, because the purpose of the system is to protect from drawdowns. And what you see here is that the last drawdown was in the region of 20%, and the system has controlled this drawdown to a very comfortable level. And it has been the case, looking back 30 years back, we have this kind of shocks. We had that 1, 2, 3, 4, 5, 6 times. So what has happened last year was one of, an event that happened every 5 years. And so the system has been reacting well with that. System is pretty good in all the difficult countries, such as, look at, let's say, Japan, for example. Japan is wonderful because Japan is all about risk. Italy is the same. All these countries are all about risk, so they're doing very well. Sometimes, well, if you look at, for example, USA, it's more difficult because USA is constantly going up, so the system does not add much value, apart from time crashes times. But sometimes it really doesn't work. If you go back to, for example, the Asian crisis in 1998, you see that the system has lost 50%. So if there is something happening structurally in, for example, a depegging of a currency or the euro breaking out or something like that, probably the system won't see it. The system has no view on balance sheet. It only looks at flows, and it has no idea about the leverage on the market. It has no idea about structural things. Today, if we go back to today, for every month, what we do as well is we calculate intra-month signals to get you prepared to the next following heat map. The system doesn't take them into account, but it's in order to converge from one heat map to another one, which is a monthly one. So if we look at what the system is saying now, so that was yesterday update for what is going to be probably the heat map at the end of the month, we see that there is a significant change. So for the first time in 7 months, the system is saying that it is becoming unstable. And major markets are hit by that: the US, Euro, China, Russia, Hong Kong. Only few big markets are still blue, including India. So that's a warning signal. at the end, if you are interested in this type of system, then you can download it from our website, which is gavekalintelligencesoftware.com, on your PC. If you download it, then the system will ask you who you are and what's your company, and do you want a 3-month free trial period? And if you say yes, then we will send you back a password, and then you input the password and you are up and running. You can as well download it on your iPad. You just type TrackMacro on the Apple Store and you can download it. And if you want to have a quick review of how it works, you type TrackMacro on YouTube, and you have a tutorial which has been done by Will. Thank you, Will. And then you will see how it works. It's pretty simple in terms of utilization. Thank you very much.